Hello everyone, this is Sunny and welcome to this video called Top 5 Stocks with about 5% dividend yield. So recently the markets have corrected about 20% from the top, so we're almost in a bear market, but we're also having really good opportunities out there. So if you're a dividend stock kind of investor or a dividend growth stock kind of an investor, there are many companies that are yielding way more than they used to just a little bit while back, and they don't really have existential problems or recessionary problems as we see right now, or at least as of now. So this video, I'm going to point towards 5 stocks from different industries which appear to have stable businesses at least, if not growing, and they are yielding about 5%. So between 4.5% to 5.5%, right about there in that range, depending on where you buy exactly. And so just for record, we have not included stocks which yield way more than this as well. So there's stocks like AT&T, Ford, which yield about 7.5%. There are also many stocks out there which yield in double digits, but we're not including stocks which have some red flags. We're including stable companies, good companies, which are about 5% dividend yields. And we're also not including stocks which are dividend growth kind of companies, which I actually personally like, which yield about 2 to 3%, but may yield a lot more over time. But as we said, sticking to the theme, I'm going to point out in this video 5 stocks that yield about 5%. So let's get started. So here we go. As you can see, well, you can see my screen now. The first stock we're going to talk about is General Motors. So General Motors and Fiat Chrysler are my 2 automobile picks that I've favored for since a while. Fiat Chrysler, I really like how cheap that is, but it's not really a company that pays dividends. So we're going back to General Motors for dividends. So the market cap is about $48 billion. There is a lot of debt, but a lot of debt is captive finance debt. So it does not, like, they're financing their own vehicles. So it's not really, the entire debt is not what we would consider as a debt otherwise. So it's not as bad as it looks, but it still has a lot of debt to be at this point of the cycle. If the cycle is ending, that is, when people say at this point of the cycle, we're assuming they know exactly where we are. It's always a intake, but it's super cheap in terms of about less than 6 PE and a forward dividend yield of 4.44% right now. So it pays about $152 a year, so that's like 38 cents a quarter. So anytime you buy the stock under $38, it's paying you more than 4% in dividend yield, and then depending on how low you go, it may be 5% or in between that. If you look at the performance, the recent performance, they've been discontinuing a lot of models. There have been that's the reason they were in news recently for closing one of their plants and affecting the political scenario as well due to how the jobs will be affected in those regions. But anyways, my point is they're getting out of certain businesses, certain lines, sedans, and they're also focusing on new businesses like cruise. So revenue on a whole, they're maintaining it flat or slightly down. And they have, at this point in time, with their cost structure, much improved cost structure, they're yielding about $6 in earnings a year. So when we look at what they're paying for 4.5%, right, even though they're paying 4.5%, they're paying us basically $1.50 out of that $6. So that's a payout ratio of less than a quarter. This is really good. So they have a lot of money still to invest even after this payout to invest in their growth or pay down debt. So that tells me the dividends pretty much safe right now, unless like a real downturn comes. So as we see, the payout ratio has been about quarter for a while now, which is really good. So don't expect like a lot of dividend growth unless they feel that they are in a place where we're not in the top of the cycle. If they feel like it, there might be actually possibility of a growth, but otherwise, even with no growth, I'm not satisfied either. So recent growth has been tremendous. So from 2014, 120 to now 150. But depending on the fact that we don't know exactly where we are in the cycle, we shouldn't expect a lot of growth, but there is a lot of safety within this growth already. So it used to yield about 3.5% or so, and recently the yield has gone about 4.5%. Warren Buffett has also been buying into the stock. Cruise is like a wild card. It could be into their autonomous driving ride-sharing service that can be a factor in 2020. But okay, we're not getting into speculating here, but what I'm saying is very decent payout ratio. I don't think we're like that bad in the cycle right now, and even if we are, General Motors is now cost structure-wise very more prepared than it was before. Yielding 4.5%, I'll take this stock. I'm actually personally invested in this stock as well. Avago, let's do the next one. This semiconductor company, one of the best performing semiconductor companies recently. So one of the reasons why most semiconductor companies are not performing well recently is because of the cyclicality. They've been caught into the cyclical cycle of high inventories, and they will take about 2 to 3 quarters to clear it off. But Avago has been very persistent in terms of bucking the trend of cyclicality. It's still growing and going well, and has actually surprised the earnings the last quarter, the last quarter as well. And the balance sheet is pretty much solid. The debt, as we see, would go higher a little bit than what we see due to their recent acquisition of CA. But their CA acquisition is also very timely, as it gives more stability to the business. So stability right now in semiconductor stocks is something that would reduce the cyclicality and would increase the valuations. And Hawk Tan, the CEO, always take right steps at the right time. I don't know if it's like by chance, by luck, or by really, really, really thoughtful behavior. So when the authorities, the regulations were allowing a lot of takeover, the space was growing, they did a lot of acquisitions, and now they're focusing on stability, and that is improving their valuations. So even then, the company sells like really cheap, about 9-10 times forward earnings, and the dividend growth has been enormous, and now they're yielding about $10 in dividends a year, and the forward yield is now 4.4%. So as you can see, their wireless business has been stable as well. They have grown 17% this year. This would be due to the acquisition of CA Technologies, and then the stable growth about 5% to 6%. Again, very much valued is the stability in the business. And if you look at the dividend growth, that will blow your mind apart, and that's because of a change in strategy from doing acquisitions to paying more back to the shareholders. So capital return policy now for Avago is about 50%. So they're going about half of the cash flow and the earnings they're returning to the shareholders. So 2011, the dividend was 40 cents. In 2017, it went to 4.8, and now it's 10.6. So as you can see, the 3-year growth rate, 5-year growth rate, everything is more than 50%. Shouldn't expect this going forward, because this is due to the change in strategy that we see from not paying dividends to almost half of the returns going back to the investors. So shouldn't expect like this rate of growth again. But now with stable cash flow operations, the dividend should be pretty safe. The dividend yield, which was very low before, about 1, went up to 4 now. Above 4 now. That's because of the dividend increases we saw recently. Now, this is amazing. If you see yield on cost, what does yield on cost mean? If you bought a stock at 100, let's say it yielded $2 in dividends a year. Now the stock is at 200, and the dollar and the dividend per year now is $4. The yield on cost for you would be $4 in dividend that pays now versus your buy price, which was 100. So it's yield on cost of 4. Although the current yield is 2%. If this is confusing, that's okay. I went through it real quick, but we may do a really different video on that. But looking at this chart, the simple explanation is, if you bought this stock about 5 years ago, today your yield on how much you invested then is 20%. So that's really amazing. So let's say, like, for example, 5 years back, the stock was at 50, right? You bought the stock, you didn't think about the dividend, and here you are today, and the stock pays about $10 in dividends a year. What is that for your $50 investment? It's 20%, right? That's 20% yield on cost on what you invested. So it's really amazing how it yields 20% on people who bought it 5 years before. 20%, I mean, what more people want, right? But again, it won't keep growing at this rate. But let's see. It's a company that I would be willing to bet on, and I am actually an investor in that too. Exxon Mobil is the third one. We're taking a move to the energy now. Now, Exxon Mobil, if you look at the balance sheet, it has a lot of debt, but again, within the energy sector, it's one of the cleanest balance sheets. So the forward PE is 13. The PE doesn't really matter that much, because the earnings keep going up and down with the stock price, with the oil price, and which is very volatile, as we've seen. So 2018, the revenues were 30% to 318 billion. Next year, it's about 5%. This growth was supposed to be way higher. Now, recently, with the oil price coming down, it's being revised lower. So the earnings are very volatile depending on the oil prices. That is something to keep in mind here. So they earn about $5 a year right now. And to yield what they yield now, that is 4.8%, they'll be paying $3.3 in dividends. So out of 5, they're paying me 3.3. So the first impression is that, as you guessed it, the payout ratio is pretty high. Now, the risk here really is when we see a payout ratio, we are basically saying how much this pays in dividends to how much the company earns. Now, what the company earns, that number itself is so radically variable to the price of oil that the payout ratio can go up and down. So, for example, if the oil prices go to $100, the earnings go really up. The payout ratio would decline really quick. But if we see the dividend safety right now, if we've seen like past couple of years when the oil prices dropped so much, the payout ratio was actually 140%. So the company was paying us way more than what it was earning due to the oil price downturn. Now, what I'm saying is this company carries the risk that if the oil prices stay low and low for long enough and the payout ratio keeps going up above 100%, you might be saying that this is a company at the risk of cutting its dividend. And I may say that what you're saying is probably right, because you don't ever want to see that. So keep in mind, although one of the cleaner balance sheets, and also although one of the best integrated operations running out there, the company payout ratio is pretty high. And depending on what you think about the oil prices, it can be not as much as a pretty picture. So full disclosure, I don't own Exxon Mobil, but if you want to diversify, I wanted to give you this option. Next one, so from automobiles to semiconductors to oil and gas, let's go to retail. Now, a lot of stocks in retail are yielding a lot higher than Macy's, but they may be in worse position than Macy's. So as I said, we're not going into something happened there. Anyways, a red flag companies. So we're not going there. Macy's was really in trouble about a year back. It was about $18 a share. And then it's been turned around a little, and the valuations were really attractive then. It doubled, more than doubled. It went to 40, and now it's back to 30. Let's see how it looks now. So the market cap is about $9 billion, and still the company has a lot of debt. About 50% of the market cap is debt, and it pays a forward dividend of $1.50 per year per share. So that's about 5.2%. So let's see how much it earns, how the business is looking like. So after the recent decline, the good thing is the decline has stopped, or at least stabilized. So, but then the bad thing is the stabilizing of revenue is when the consumer is so good. So if the consumer turns bad, the negative, the decline in the revenues might start again. So that's not good. But with that caveat, what we see now is if the consumer environment continues to be good, $25 billion is where the revenues have stabilized, and they had an earnings boost this year due to the tax savings because of the tax code, but otherwise the earnings are going to be 3.6. Now out of 3.6, they're paying us 1.5 in dividends, so it's pretty safe in terms of payout ratio right now. But as I said, they do have a lot of debt, and they do not have a business that's inherently growing secularly. So if you look at the payout ratio, it's 35% or so now as per this graph, but it was lower before. So because the earnings are volatile, because the earnings might go down now with having more costs in terms of executing a true omnichannel model, the payout ratio might rise. So there is a risk of the company not executing, not keeping up with times, or not doing the omnichannel well in terms of margin profile, in which case the payout ratio might grow. So that is a caveat. But if you look at dividend growth, it's been since 2010, it's going pretty well. So till now, there haven't been a lot of red flags. Their 5-year growth rate has been 13%, pretty good growth, if you ask me. But now the growth has slowed. So like this year, last year, it just grew by 2 cents. So I'm just throwing it all there, positives and negatives. Again, as I said, I'm not promoting any company or going against any company, or I'm not short any of these companies. So I'm just giving you the scenario and what I like and not like. And in this case, what I don't like is revenue is stable in one of the best consumer environments out there. So if it takes a downturn, the revenues might go down. If margin profile is affected, it might go down. The payout ratio might go up, and that's not a good sign. But right now, as of 5%, I think it's a pretty good deal as well if you believe that the company can sustain and grow from here. Now, going from automobiles to semiconductors to oil and gas to retail, let's go to another sector and give you a little bit different flavor into pharma. So this stock I really like, and also I'm actually invested in, is Abbvie. So Abbvie has been also a very good dividend grower. So if we look at the dividend growth history, it now pays about, so if you're looking at 5 years, it used to be in January 14, it used to be 42 cents. Now it pays 96 cents, or more than double the dividend in the last 5 years. Now it pays about $4 in dividend per year. So anytime you buy the stock below like $96, you're getting 4% yield. And then the cheaper you buy it, the more you get. So the dividend yield now is 4.2%, but just about a week or a couple of weeks back, it was almost close to 5%. So depending on how the market volatility goes, you can get about 5% dividend yield in this one. And the payout ratio is about 48%. So that's like almost half, but it's a very stable company. Again, you might wonder and debate about how the future of Humira looks like and whether the company will be able to replace most of that revenues or not. But as of now, like at least for the next 3 to 5 years, the growth is looking pretty good. After that, we can debate about Humira and how that affects the business and how that might affect the payout ratio going ahead. So yes, that does carry that risk. Again, it's a biotech company after all. It does carry risk about new drugs not coming or replacing Humira revenue entirely, or Humira taking a steeper slope down than it is now in the numbers. But anyways, as of now, I like this company a lot, and the management has done a really good job in last couple years, actually last 5 years, dealing with the Humira patent issue and its eventual demise in terms of its patent life. So the forward P is 10, but again, the company carries about $25 billion in debt. With that in mind, the dividend yield here, it shows 5%. Some of these lag, so let's take by the numbers. So 4.28 is the yield. So 4.28, and the stock was about a 90. It was about 5%, and now it's yielding a little bit between 4 and 5. So with that, let's look at their dividend growth history. We looked at yield on cost is another thing that I would want to note about Abbvie. So if you bought it like in about 4 years back, your yield on cost today would be about 8%. That's really good. Again, not as good as Avago, but really good. So if you bought the stock 4 years back, your yield on cost now is 7.5%. It's really good. So again, do not expect this going ahead, because I think as the Humira thing comes closer to the expiration, they would not want to raise the dividend as much as, because they want to maintain it. They would have to maintain it, but they have been maintaining the dividend growth, and they have been working on many new drugs that may replace entirely the Humira revenues. So it might not be that bad. But the key risk, as I said, was Humira's eventual decline and how they replace that. So again, summarizing, not one of the best yielding stocks out there, but the companies that I think in various different sectors are a bit, which are pretty diverse and have decent balance sheets, if not terrible or great. But these are the stocks. Personally, if you ask me, I am invested and more bullish about GM, Avago, and Abbvie. Those are the three that I'm invested in myself, and I have belief in them stabilizing and getting better. And 2 at 3 went for diversity, but I'm not interested. I am interested, but I'm not invested in myself right now, or Macy's and Exxon Mobil, but I may be. So that's that. We may do a different video on how I evaluate dividend stocks in general, how what dividend growth stocks I'm looking at. So let me know whatever you would think you would want me to do a further video on. Possible options and choices are: how do I go about choosing dividend stocks? How do I go on deciding dividend growth stocks? What are my top 5 dividend growth picks right now? And what is that video on yield on cost, and how does that work? And many other things that we can talk about. So anyways, for this video, I hope I did justice to the title, 5 dividend stocks for yielding about 5%. And if you have any questions, leave in comments, let me know. We are gonna stop the recording now, but I hope it was helpful, in which case to definitely share with anybody you want to focus on dividend as well.